Kia ora, I'm Nadine Higgins and welcome to your personal finance podcast, The Prosperity Project. On this podcast, I'm on a mission to empower you financially. I am a columnist and a journalist, an investor, a financial advisor, and the mum of a toddler, but I do not claim to be the font of all knowledge. I'm still figuring it out too. And that's why I'll be bringing you the experts and mining their big brains for all the things you and I need to know every week. Right now, if you have a mortgage, you are likely weighing up your next move after the Reserve Bank cut the official cash rate from 4.25% to 3.75%. More than 80% of mortgages are due to refix this year because most people have been opting for the floating rates or the short terms, waiting for the right time to pounce. So, is that time now? Or should you continue to wait? To help us figure that out and sift through the economic tea leaves, we're joined by the founder of Squirrel Mortgages, John Bolton, or JB. Kia ora, JB.
Kia ora.
So what do you think? Up until now, lots of people have been waiting. Is it time to act now?
Yeah, I think so. Oh, look, I think most Kiwis have got it right this time around. They were fixing short term in anticipation that rates would fall. I guess the great news is rates have been falling, right? Those short term rates are expensive. You know, we've still got 6-month fixed rates, currently around 5.8, although I'd expect those to drop to around 5.5% in the next week or so. But that's still relatively high when you think that you can get a 2-year or a 3-year fixed rate at 4.99, right? So you're paying extra to stay on those short-term rates in anticipation that rates will fall further. I guess that's the key question. Will rates fall further?
Well, exactly. And I know that some people have looked at those 4.99% rates and thought, well, that's looking good, but do I risk going too early when it could get better? So is it going to get better?
Yeah. So look, the first thing I'd sort of say is there's this amazing thing in New Zealand that you would think we just won the Olympics, you know, like the OCR announcements, the whole country comes to a halt. It's the main news item. It's an interest rate.
Yeah.
I think we've probably got the best.
We're all highly indebted, so it matters.
That's true, right? I reckon our Reserve Bank Governor, Adrian, would have probably the highest name recognition, you know, in a country for a Reserve Bank Governor. Most countries wouldn't know who the hell their Reserve Bank Governor is. But
we don't have 30-year fixed rates, so we pay attention to this a lot more regularly, don't we?
And we have volatility in interest rates, right? Much more than most countries where, you know, we've experienced the highs and the lows. And I guess that's the thing. The first thing I would sort of say is just got to be very careful that we don't anchor ourselves around expectations that we're going to see sort of COVID-type interest rates again.
So rates in the 2s off the table.
Even in the 3s.
Yep.
So, you've got a Reserve Bank out there that's saying that a neutral interest rate is around 3%, so a neutral OCR. We're at 3.75 now, so there's still some room to get to 3. The Reserve Bank Governor in his media conference afterwards pretty much indicated that we'll get another 25 points in the next, 0.25% in the next 2 OCR announcements. So I'd expect us to be back at 3% by the middle of the year, which says that the economy is on a neutral footing, right? It's not too hot, it's not too cold.
But I think what people assume is he might cut by a quarter, maybe another quarter. So does that mean I can expect my fixed rates to come down by the same margin or not?
No, and that's really important. So the answer to that is no. The wholesale markets which banks price off have already factored this in. So, you know, what's changed between the previous announcement last year in November and now is that the Reserve Bank has brought forward its forecast of how quickly it'll drop rates. So if we went back to November last year, it very clearly signaled that it was going to drop 0.5% this time, right? But it said it wouldn't get back to neutral until next year, 2026. And probably mid-2026. Whereas this time round, they dropped it 0.5%, but they said they'd get us back to neutral this year. And it's that bringing forward the rate reductions that is driving down the mortgage rates at the moment because, you know, they've brought it forward. To be fair, the markets had already anticipated that. So it's largely priced in, particularly for the longer-term rates. So, you know, we are seeing those 2- and 3-year rates down now around 4.99, but that's it's already pricing in the future rate cuts.
So just because there are more cuts to the official cash rate to come doesn't mean that you can see a commensurate move in those longer term fixed rates by the time that happens.
Exactly. So those are largely reaching their bottom now. What you will see is those shorter term rates continue to fall. But as I said, the 6-month rate's currently at 5.8. I'd expect it to be 5.5 within a couple of weeks. Obviously, as those OCR changes come through, I'd expect to see the 6-month and the 1-year rate drop below 5%. And I guess the question is, how low will they go and when will that occur, right? Now, at the short end, I guess what we're sort of saying is if a neutral OCR is around 3%, and we are starting to see the odd green shoot that suggests the economy's gradually coming out of recession. So we get back to neutral. That would suggest that you would have a 1-year fixed rate of around 4.7 to 4.8%. And that's as low as it will get in a neutral environment. If our economy continues to bump along and do terribly, and we don't get that great growth that the government's hoping for, then rates could go a bit lower than that because arguably the Reserve Bank would have to cut the OCR below neutral. But if things sort of settle down, which it feels like it's starting to, then really the bottom of the rate curve is very, very close. It's going to be around sort of 4.7, 4.8%. Now we've already got 2 and 3 year rates down at 4.99. So it's a great rate,
I guess I wonder whether what people overlook a little bit in their fixation on locking in the lowest rate and not feeling like they're missing out on that is they might be accepting higher rates in the meantime, whether they're floating at the moment and continuing to float or whether they are picking those 6-month rates, which are still considerably higher. So they're paying more now in order to save some later, but does one offset the other?
Yeah, no, you're absolutely right. And I think when rates were falling quite quickly from what were very high rates, right? Because let's remember, it wasn't that long ago that people were paying 7% on their mortgage. So that was the right decision. We had a quick succession of fairly large rate falls. People were paying more to stay floating, and most people stayed floating. Some went to 6-month fixed. They were paying more in anticipation of getting significantly better rates. The gap's closed, right? So what you're doing now is you're paying more for what's going to be only a small reduction in rates. And that doesn't necessarily make as much sense. The other side of it is, there's a lot of uncertainty out there. None of this is perfectly predictable, right? So, those longer term fixed rates, you might pay a little bit more for them, but with certainty what you're getting. Whereas this game of sort of trying to predict the bottom is a little bit uncertain. And we've been here before, right? Because we had a whole lot of people doing short-term fixed rates when rates went up, instead of fixing a little bit longer for 3 to 5 years.
They just wanted the cheapest rate, but then that maybe came back to bite them later when in a year's time the rate was higher.
Where I get to in this part of the cycle is don't sort of try and guess the bottom. My view is sort of most clients, we split their loan into 2 or 3 parts so that they have it maturing at different times, and that sort of de-risks them getting it wrong. And so now I'm sort of like, well, I'd be encouraging people to go and fix part of their loan for 2 or 3 years if they can get a rate below 5%. By all means, leave some of it on a floating or a short-term fixed rate in anticipation that they should get maybe another 0.5% reduction in rates over the next 3 or 4 months.
And hey, let's also focus on what you might be saving rather than what you might be missing out on by not going now. I ran some numbers for a client yesterday who was refixing some personal debt, some investment property debt. It was a difference of $22,000 over the course of the year, going from almost 7 down to 4.99. So, I mean, obviously that's a lot of debt.
Yeah.
But that's a big saving.
Yeah, no, it totally is. Look, I've got a whole lot of loans rolling at the moment, and I'm with ASB, and so I'm just waiting for them to get down to 4.99.
We're going to talk a little bit more. Yeah, we're going to talk a little bit more about the bank competition after the break, because I guess that's the next thing, right? We've got interest rates coming down, but how hard are they going to work for our business? So I'm talking to John Bolton from Squirrel Mortgages. We'll be back right after this. Welcome back to the Prosperity Project. We're talking to John Bolton from Squirrel Mortgages after the cut to the official cash rate and kind of what that means for your mortgage and what next. One of the things that really interested me, JB, was while all of the banks were coming out saying, here's our cuts to our floating rates and our fixed rates, Westpac came out, who had this market-leading 3-year rate at 4.99% and said, we're pulling it and we're pushing it back up over 5. What was that about?
Yeah. Look, I came out before Christmas and said I was expecting to see a 499 rate, maybe before Christmas, but certainly in January. And I was very grateful to Westpac that they delivered on that because I was starting to look a bit stupid. Look, what it is competition, and it's competition just doing its magic, right? The banks were always going to want to go below 5% because, they have a headline that's got a 4 in front of it was always going to be a good thing, right? But they're also very conscious of their margins, and they didn't have the margin there, or they haven't got the margin there at the moment to really go below 5%. But it's so attractive, they'll go down there if it means winning more market share.
Is that an indication, given that other banks are offering it for 2 years, that they're sort of looking ahead and thinking 4.99 might look quite cheap in a couple of years' time? Are they already looking at the other side of the cycle?
No, what they're doing is there's really heightened level of competition amongst the banks, right? Westpac's been losing a bit of market share lately because it wasn't overly competitive in the market for the past 12 months. And so they need to get market share back. They're looking at ways to do that. They thought putting a cheeky offer out at 3 years for $4.99 was a good way to do it. And anecdotally it was. They had a significant increase in activity coming through their business. And so it worked well for them. They were the first bank to go below 5%. They got the headlines and they won a lot of new business off the back of it. In a way, Westpac's move, I think, is what's driven more banks now to go to 4.99. But of course, they've decided to do it with the 2-year rate.
So I guess it's music to everyone's ears if the banks are competing hard for our business. But how do we make the most of that for our own mortgages, structures, cashback payments?
Yeah. Well, the first thing I'd sort of say is that 4.99 rate that's out there at the moment is very competitive. The banks are writing that at lower margins. And so it's priced pretty tightly. So there's not a lot of negotiation in that rate. So, getting 4.99, it's a great rate. You might be able to negotiate a little bit better than that. The other side of it is cashbacks, which have been floating around in our market for a long time now. If you refinance from one bank to another, you'll typically get offered a cashback. That cashback can be up to 0.9%. So to put that in perspective, if you had a $600,000 mortgage, you might get $5,000 cashback, which is worthwhile, right? I mean, if you convert that into an hourly rate, it's like earning about $300. It's in terms of the amount of effort it takes to refinance, it's pretty good value for money.
Do we also have to point out, though, there are some fish hooks, right? Like there is no such thing as a free lunch. They're kind of bonding you to stay with them for a period of time.
They do. So the thing with cashbacks, you've got to stay with the bank for 3 years. But if you're not refinancing and not getting the cash back and simply taking the rate, then you're missing out on some real money, right? Yes, you're bound to that bank for 3 years, but hey, you're getting competitive rates and you're getting cash back. It makes good sense.
Well, and the data I've looked at is that most of us don't actually switch banks very often, but that maybe it's starting to change. There was some data out from the Reserve Bank, I think, in December that there was like $2 billion of mortgages that had switched banks.
Yeah.
So do you think that people are waking up to the idea that you're not rewarded for your loyalty to a bank?
Yeah, no, absolutely. And look, I guess banks historically have relied, that's why they do cashbacks, they've relied on being able to compete for new business without having to compete as hard for their existing customers. And that's the logic that sits beneath cashbacks. So it works well for the banks. For consumers, it means, the unfortunate side of that is that you are going to be better off looking at refinancing.
So there's a bit of life admin, lots of paperwork, but it can be worth your while.
Yeah, I don't know that it's something you want to do all that often, but, as long as you've been with your bank for over 3 years, because these cashbacks can get clawed back, then it's certainly something that's worth thinking about.
Well, and I guess for those people who have been going short and they've got their whole loan kind of coming off fixed rates, there is less to tie them to their current bank. If you're thinking about refinancing, can you also go back to your current bank and say, hey, any incentive to stay?
Of course you can. Of course you can. So, and look, if you're in a legitimate position to move because your loan's on floating or it's on, maturing short-term fixed rates, then, your bank's going to view that as something that they would pay a retention payment on.
Yeah, and so then you don't get the life admin and you still get a bit of a kickback.
Yeah. You might not get quite as much kickback, but look, there's definitely room to negotiate.
How do you see the external to New Zealand risks playing out? Because, of course, everyone's going, what about tariffs? What about Trump? What is that going to mean for our interest rate environment? Because we know that the official cash rate's not the only determinant of where our mortgage rates end up. There's the wholesale market. So what emphasis should we put on all of the overseas ructions?
I don't think a hell of a lot. Look, I think there's a huge amount of curiosity as to what's going on over there. I mean, it's riveting.
Is it curiosity? Is it horror? I don't know.
To be honest, look, I was probably in the camp of Trump, it's probably okay. But I got to say, in the last couple of days with his outbursts on Ukraine, I've gone dark on him. I've gone really dark on him in the last couple of days. And, he's obviously very destabilising globally. That has with it, significant inherent risk. I guess that's what you might call a black swan event. Arguably a black swan event is it's unpredictable. Given we've got Trump in power in the US now, arguably it's not a black swan event because everyone
it's just business as normal.
It should be predictable. Look, there's a lot of geopolitical risk out there, and we've got to take that into account. The Reserve Bank here drives short-term interest rates. They're clearly driving those down to sort of stabilise the economy, hopefully get a little bit of growth back. They control that end of the curve. The long end of the curve, so those longer term fixed rates, 3-year fixed through to 5-year fixed, that's going to be dictated by international investors, and international investors are going to be a lot more swayed by what's going on geopolitically. So I think even the governor came out and said, look, don't get too optimistic about falling long-term mortgage rates with so much going on around the world. And that's what I was sort of saying earlier, a 4.99 rate for 3 years actually looks really attractive when you sort of put that wider context on it. But the shorter term rates will continue to come down, and they're largely dictated by what's happening domestically.
I know you've got lots of clients who have businesses, and when I spoke to you last year, you talked about how a lot of them were having a really hard time, and we were seeing more receiverships and the like, and I guess that's what starts to tell us, where unemployment might go and how the economy's going. What are you seeing anything differently in 2025?
It's still tough out there. Look, I think the thing I would sort of say, and this is true of New Zealand Inc. generally, is that, these high interest rates that we had really hurt. Now, they hurt consumers, and everyone out there's been sort of juggling to survive. Because you not only have you had unaffordable mortgages, but you've also had significant increase in costs, in terms of food, but then rates and insurance. Like, I can't believe how much I'm spending on rates and insurance now. It's a massive part of my non-discretionary income. And so, we're still grappling with this significant increase in costs. The mortgage rate's coming down. That's going to help. But I think for most people, it's just helping them repair their balance sheet. It's helping them get back to some sense of normal where they're not going backwards. It's not going to give people the confidence to go out and buy flash new cars and go on overseas holidays they can't afford, right? So I don't think that the lower interest rates is going to translate through into consumer spending nearly as fast as you might otherwise expect it to. I certainly don't think it's going to put a rocket under the housing market.
That was going to be my next question, because most people assume, you remember what happened last time? Interest rates got cut and the housing market went gangbusters. When's that happening?
Yeah, it's not. And I think what you see at the moment is that there's a lot of people trying to sell.
Yeah.
So a lot of people have put their property on the market. Obviously, the last 2 years, it's been really hard to sell. So people have tried to sell. They've taken it off the market again. They've put it back on the market this time, hoping that lower interest rates might sort of kickstart enough demand that they can get it sold. The reality is that the demand's out there. We've got first home buyers out there. We've got maybe a bit more activity coming through from property investors. We don't have high immigration, so that pressure's not there. There's a lot of houses on the market. There's a lot of residual stock on the market. I mean, there's been a whole heap of really crappy development, particularly in Auckland. And there's a lot of low quality, pretty ugly stock that's struggling to sell.
Really hot in their upper floors too, right? That's the latest revelation from summer, is it's like 50 degrees on the top floor.
Yeah, and it's just not nice stuff. And so, they're going to struggle to sell down a lot of that residual stock because people have got choice. When you're in a hot market, people will just buy whatever they can get. But in a market where you've got a lot of choice and you've got a lot of sellers, people are going to be quite selective about what they buy. That's going to hold house prices down.
So I guess for the first home buyers out there, one of the hurdles they have to clear for borrowing is the bank's test rates. They're testing your lending at a rate that's above the market rate at the moment.
Yeah.
That was crazy high,
almost 9%.
Exactly, for a while there. Where is it sitting now with lower rates? Because I guess they can't take it all the way down because they still need to test that if rates went up again that you could handle it.
Yeah, look, typically those test rates, the rates that banks test your affordability on, are about 2% above your 2-year fixed rate. So with fixed rates now down around 5%, banks are getting closer to testing around 7%.
So that's going to be helpful for those people who are making their first foray into owning a property, right?
Yeah. No, definitely. As interest rates fall, the amount of money a bank will lend you will increase. Counteracting that a little bit is the fact that living expenses are so much higher, and so that reduces affordability. So there's some competing forces there, but credit has definitely got easier. Last year it was pretty tough for low deposit first home buyers. It has definitely got significantly easier. The other side of it is that the banks in the last year or two were quite nervous about the housing market. They were really worried about falling house prices and the impact on their balance sheets. I mean, when banks stress test their businesses, they never thought that they would actually see a 20% reduction in house prices, which is what they've seen in Wellington and Auckland.
Which, if you're buying with a 20% deposit, it kind of wipes that out, everything you sort of put into it, at least on paper.
Oh, totally. And look, there are people out there that are in that situation. It didn't destroy the economy, and things have stabilised, and things are starting to thaw, and so the banks are through that now. They're less nervous about the housing market. The world hasn't come to an end. We've got lower interest rates, so I think they're sort of starting to relax a bit more into the market now.
I just want to ask one final quick question, because there's always the flip side of the borrowers, and that is the savers. Some of those interest rates on your savings account are starting to look quite paltry, right? So does that mean people will go elsewhere looking for a better return? Is it a problem for the banks if people don't want to put it into a savings account or a term deposit?
Look, with all of the global uncertainty out there, I don't think banks are going to be too worried about deposits. Money, when you've got...
people still feel safe putting their money in the bank. Yeah,
and you've got the government guarantee coming out as well, which will certainly help bank depositors feel safe. So I mean, the problem for them is the lower interest rates, right? They're not going to get high returns. Probably more than housing, it pays to shop around. And if you've got money in a savings account, you're probably being ripped off, because most of these savings accounts do have paltry interest rates. And the thing is that people just don't look. They just think, oh, it's in a savings account. They don't actually go and look at the interest rate. Go look at it. You'll be surprised how low it is.
And remember, you have to take tax off that, right?
Yeah. So, you need to look to put it into high yielding investments. Term deposits is an obvious choice if you're wanting to leave it with a bank. But there are other options out there. At Squirrel, we've obviously got funds out there that are paying at the moment between 6 and 6.75%. So there are other options out there. I think particularly as interest rates get really low, people should look around, but they also need to be cautious. Like we've got a history in New Zealand of going and throwing our money into high-risk investments. I mean, remember the GFC and all the finance companies that went under, right? So I think by all means go out there, look at higher yields, but you need to do your homework. You need to understand what the risk looks like relative to the return.
Yes, because there's always a relationship there and you have to understand it.
Yeah, totally. It always worries me, that we rush to the higher interest rates without really understanding what the risks look like.
Well, thank you so much for your time and your expertise. Hopefully that's helped people unpick exactly what they should be focusing on while interest rates are where they're at. Really appreciate your time, JB from Squirrel Mortgages.
Thanks.
And if you are an aspiring first home buyer, make sure you tune in next week because we're going to look at some alternative ways to get on the housing ladder. Thanks for listening to The Prosperity Project. You can follow this podcast on iHeartRadio or wherever you get your podcasts, and please do chuck us a rating or a review while you're there. For more personal finance and business content, head to nzherald.co.nz, and please do feel free to get in touch with your questions and your stories. nadine.higgins at nzme.co.nz. A reminder, though, that this podcast is informational only and nothing we say here should be considered personalised financial advice. But also remember that while listening to this podcast is hopefully going to be additive to your financial knowledge, and that is fantastic, knowing stuff doesn't create change. Doing stuff does. So what action are you going to take today to make your life more prosperous? My producer for this episode is Ethan Sills. Sound engineer is Richard Martin. I'm Nadine Higgins. Thanks for listening to The Prosperity Project.